Josh Hendrickson, Chair of Economics, Professor of Economics at the University of Mississippi, now our guest. Good morning, Professor. Thanks for joining us.
Hey, thanks for having me.
You bet. So we wanted to talk to you today about the concept of money supply and how that might be impacting our wallets, how that might be influencing inflation. We were just discussing in the last hour the latest CPI report for the month of January, released yesterday morning. Month over month came in level about where most analysts and economists were expecting, but on a year-over-year basis, came in a little hot. The market wasn't quite sure how to digest that report. It wasn't as expected, as you were aware. And then this morning, we get news that retail sales rose by 3%. That came in a little higher than expected. And the Fed board and Chairman Powell, I think they're scratching their heads trying to figure out what do we do here. We've pumped rates up pretty significantly over the last year, but we're really not seeing any marked control of inflation, certainly not in line with their 2% target. Investors, I think, still are optimistic that we'll see a pivot later on this year in the rates. I don't think so. With that as a backdrop, I'll ask you to explain the money supply, the different categories of money supply, and how this figures into our daily lives.
Yeah, so as economists, we usually just kind of focus on broader measures of the money supply. So like a prime example is something that's called M2. And that just kind of includes a broad spectrum of different types of money. So currency, your checking account, bank, savings accounts, CDs, things like that. And the reason that we look at those things is what the Fed actually is adjusting when they're doing all of these asset purchases that they do, is they're just adjusting, currency and bank reserves. And sometimes, the increase in bank reserves is because banks want to hold more reserves for whatever reason. And so if that's the case, when you look at these broader measures of the money supply, you don't see any kind of increase in the money supply. But if they're kind of creating too much money, if they're creating too many reserves, then you'll see an expansion of these broad measures of the money supply. And I think that if you think about what's going on now, a lot of it is due to what they were doing during the pandemic. And so during the pandemic, they were really committed to trying to make sure that their own policies wouldn't make things worse. And so they started going out and buying a lot of assets. And if you look at broad measures of the money supply, we saw unprecedented growth in the money supply. So the idea that we've had inflation in the aftermath of that unprecedented increase in the money supply is not surprising. We saw money growth get to about 25%, which is like the highest in the post-war era. I mean, to put this in perspective, the high inflation in the 1970s, money growth was only around 10% back then, and it was 25% during the pandemic. And so a lot of this inflation that we're experiencing now is as a result of that dramatic increase in the money supply.
And so just to clarify for the audience, Professor, when you stated that these actions of pumping up the money supply, the bond buying by the Fed and all of these other bills that were passed, which essentially just distributed money out to the population, the policy specifically they were trying to, mitigate were those where they were locking up folks, basically. And just to clarify, that's what you're talking about, where we were telling people to stay home, don't work, and really shutting the economy down to a great extent.
Yeah, and so on the aspect of this that pertains to the Fed, I mean, one of the things they were concerned about is that there was a lot of uncertainty in the economy. There was a lot of uncertainty about how long these lockdowns would last. And, Fed policymakers were not making those policies. And so one of the things that they were trying to do is, like, normally during periods of uncertainty, banks want to hold more reserves. And so they were kind of going out there and buying assets to supply the banks with reserves. But the growth in the money supply suggests that they were doing way too many purchases, that they were purchasing way too many assets. They were increasing bank reserves by way too much relative to what banks wanted to hold. And so banks are going to find things to do with that money, right? They're going to lend it out. But there's also an aspect of this in the sense that the assets that they're buying are U.S. Treasury bonds. And
Right.
so the government was sending checks to everybody, and they're paying for these by issuing treasuries. And then the Fed was going out and buying the treasuries. And
Printing
so
money,
that,
right? Printing money,
exactly,
ordering the
yeah.
Treasury to print the money, essentially to
Yeah, so
buy those assets.
yeah, so I mean, the simple way of looking at this is like, yes, the Treasury was sending out the checks to people, but the Treasury was kind of paying for this uh, by the Fed creating the money and buying these bonds. So,
Just a shell game, essentially.
yeah, and
And
so
and
when
I'm
you have this increase, yeah, you're gonna see higher prices because what do people do when they get these checks? Is during periods of uncertainty, people might just hang on to that money, just in case, but but if you're increasing the money supply by too much, what happens is like this sort of makes people feel temporarily wealthier. So they go out and they spend the money, and as they spend the money, that just leads to higher prices.
And that's precisely what happened. I describe it as just dropping money out of helicopters, which is essentially what happened because it wasn't money that was produced by economic activity. It was fabricated, essentially. And then we sent it to everybody, and what did they do? They went out and spent money. There are some reports that say a lot of people paid debt off. That was a prime use of those funds. But now we're seeing, Professor, an uptick in debt. Consumer debt. People are having to use credit cards to buy groceries. And you're aware that the credit card companies track all those categories of activity in use of those cards, and that's disturbing economists. We're also seeing a trend where lots of folks are dipping into their 401k plans to make ends meet and paying the taxes when they withdraw those funds. That's taxed as ordinary income. These are all indicators to economists that think we're not going to be able to avoid a hard landing, as it is described. What do you think?
Yeah, I think kind of the thing that's most concerning to me is that the inflation that we saw was due to this dramatic increase in the money supply. But the contractionary policy that they're following now has led to money growth actually now being negative. So now they're pulling money out of the system. And typically, money growth hasn't been negative in the post war period. So the last time it was negative was during the Volcker disinflation. And we know that, Volcker successfully brought down inflation, but he also created a recession in the process. And so it looks like they're following the same sort of path, and that they're um, going to try to uh, bring down inflation uh, by engineering another recession.
Yeah, I think the Fed is at the point where they're not seeing the demand destruction that they anticipated by raising rates, which I think gives them the cover to continue to raise rates even to a higher level. And until they see some sort of retail sales report like we got today that doesn't reflect an increase, until they see a decrease of that, and they see unemployment reports that show that more job losses, honestly, and an uptick in the unemployment rate, I think they're going to continue to be aggressive. Your thoughts?
Yeah, I think this is my concern. If you're thinking about inflation, what you really want to focus on is the money supply, but there's lags in the effect of the money supply. So the dramatic increase in the money supply started in 2020. And once things started reopening in 2021, that's when you started seeing inflation, but inflation rose throughout 2021, and then it remained high throughout 2022. And so now that they've started conducting contractionary policy, the money supply has started to decline, and so we should expect to see inflation start to come down. But you're not going to see it, for months. So I mean, even if they just stopped right now, we still wouldn't see inflation come down until probably June or July or August or something like that.
Right.
But what they're focused on is they're focused on this idea that uh, I thought died in the 1970s, which is the Phillips curve. And this is this idea that, well, if unemployment is low, that's what's causing inflation. And so they're not focusing enough on the money supply and interest rates. They're focusing too much on looking at the labor market and saying, well, unemployment's low, so inflation isn't going to come down anytime soon. And if that's your focus, then essentially what your policy becomes is the only way to bring down inflation is to make unemployment really high, which is A, not necessary, and B, is not grounded in economic theory. So you're just going to create a recession and make things worse.
And I've said on the show, they're looking to kill jobs. Until they see some killing of the jobs, they're not going to relent on and hold back on raising rates. Is what it looks like to me. Professor, appreciate you joining us today. Very insightful, sir. Thanks a lot, and I look forward to talking to you some more. Thanks. See you later.
For having me.